Mhm.
And it looked like, well, you're going to turn higher. Instead, gold lost like $50 the next day. Whoa, what the
Yeah, I
hell
believe
happened?
that was August 8th.
Yes, that was the day.
Yeah.
And I got caught in that as well. And
So when we look at the relationship to gold, or some of these relationships to gold, how do real yields fit in there, and how closely do you pay attention to yields when you're deciding to enter a trade?
well, when gold really stopped reacting to real yields back in August of 2020, because real yields actually continued to move lower. But historically, once they get this low, gold just it doesn't react to them anymore the way that it had. And then any turn to the upside, however slight, gold tends to react dramatically to the downside. Just a function of, if you're a nickel away from zero, how much closer to zero can you get? It can only go to as opposed to being $10 on its way to zero. So I think it's a function of just where they are, where real yields are.
Mm-hmm. So how is the copper to gold ratio instructive for you to determine where yields are heading?
Well, historically, oddly enough, the copper gold ratio has tended to forecast where the 10-year note yield is going to go. Now, there's no rule that says that has to be the case. It's just historically that's been a good correlation.
Mm-hmm.
And just here over the last couple of weeks, we had a spike up in that ratio to the upside as copper, neared its all-time high, and gold did not. But since then, that ratio has actually fallen back again. So what it may suggest is that yields in the long end could spike to the upside here in the next month or so, and then turn back over and come down again. Could be potentially what that is suggesting. And perhaps that's because the Fed does announce a faster than expected taper, and the initial reaction is bond yields spike and equities and commodities turn over, but then equities and commodities keep turning over, and then yields come in at that point. Mm-hmm. It's one possibility.
So in that case, Lance, are yields still a major factor in your gold model? And can you share with us some of what the other factors are that go into this gold model?
They're the DSI, the HDNSI, the COT, moving averages, a bunch of other stuff that's complicated, but it's got a lot of different components to it. Let's just put it that way.
Mm-hmm. So is it
at the moment it's neutral, mm-hmm. and that's kind of the way it operates. The last time I got a sell signal, an actual sell, was in August of 2020, and since then, each one basically would have, in hindsight, been bear market rallies. I've got what is the weakest buy signal I can get, and then that inverted back in July. So in other words, and this happened in 2018 when we started the downtrend into that September low in 2018. I was getting tier 3 buys. The price kept moving lower in GDX and gold. So it was almost, the bear market was so strong that the buys didn't matter, and it inversely became a sell. And we've seen that, I think, 3 different times since July. Now, the most recent one, actually, I did get on the low and it worked. But the prior 3, I didn't trust it because the prior 3 just indicated more selling. Mm-hmm. But it's been, you've had a straight up move since the last day of September, at least in the mining stocks. Gold's been more labored. But it's nothing. The GDX has been above the 5-day moving average every day for the month of October, including today still. So, as long as that trend continues, you'd argue give the benefit of the doubt to the upside, but that kind of move is more indicative of a squeeze in a bear market rally than a bull market one. If you go back and let's say the rally that off of the 2020 low in March, you broke that 5-day numerous times on the way up, where you got little head fakes downside, sucked in some sellers, buyers came in, took off again. But this just relentless, where you're above the 5-day every day. It's fun, but if you look back historically, it doesn't tend to last. It's kind of the candle that burns at both ends burns half as long.
So is this kind of the same reasoning that, when you get these tier 3 buy signals, that your model puts out, is it a kind of bearish signal that many of them get sold on top of that?
If typically the way it works, if the model gives a tier 3 buy, now this doesn't happen with tier 1. At least I've never seen it happen, and when I back tested it, it's never happened. It could happen in theory, but when the tier 3, when I get it, if price doesn't immediately move higher the next day, it's actually a bearish signal. Like, for example, back in, was it July or August that we got the employment report and gold got hammered? I think it was July. It was late. It was like late July, early August. Anyway, the day before, I got a tier 3 buy. The day before that jobs report, and it looked like, well, you're going to turn higher. Instead, gold lost like $50 the next day. Whoa,
Yeah, I believe that was August 8th.
Yes, that was the day. Yep. And I got caught in that as well. And because I'd had tier 3 buys in late June and early July, and price did turn up. The equities, the mining stocks rallied like they had before, although there was a curious divergence at the time between the gold price and the mining stocks, even then, where they actually underperformed, didn't act like it normally does, which was actually a heads up to something's wrong. But that would be, and in that particular case, that was clearly a bearish signal, and it was bearish for the next, 2 months, especially in the mining stocks, which went nowhere but down, even when gold rallied. Mm-hmm. So from the standpoint of, you kind of have to know how to read the model, within the environment. It's not just a,
red light, green light,
green or red sign that tells you to do something. You kind of have to interpret it a little bit. I wish it was more simple than that, but it's not. Mm-hmm.